Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. Thomas Doty, this is our 92nd show, 92 shows.
Don't seem like that many, but
I
wow.
know, because we've been having that much fun informing the people. Just want to thank everybody who's been joining us each and every week. We don't take it lightly. We're so thankful and grateful. And we hope that we're providing you with informative and inspiring information so that you too may be able to grow your wealth and also continue to grow generational wealth. As always, we like for you to click on the like button and the heart button and put comments in the comment box. We sure enough really would like for you to do that because that helps us in a big way to reach more people. Today is Thursday, March the 16th, 2023. I was told, though, to make sure we do that because I had people coming on to our old shows and thinking that it was live on today. And they're like, man, I wonder why they're not responding to us. So I'll make sure I say what the dates are now so everybody know when we're live and when we're archived. So, Dope, last week, man, we had a great conversation on lessons from being broke because a lot of people didn't know where we were coming from. But you know what was so interesting? The people who were broke before they did. That was so interesting. So I had so many good comments. But today is going to be, like all our shows, excellent. But this today is even more excellent because this topic, keep cool during turbulent times in the market. So many calls, though, I received today. This week was amazing because of the market and the bank closing and everything. It's people who are already panicking. But what do we say? Stay steady.
Stay steady.
Stay steady and stay cool. So we're going to open up with, and a lot of people don't really want to see this information we're going to give them about the stock market, but they're going to be pretty shocked today.
Yeah, the market had a pretty nice run. It's going to continue to be up and down depending on what the Fed does. The big rally this last week or so has been a follow-up to big drops because of what's going on in the banking industry. Bob's going to give you a little more detail on that in a minute. But
I thought it was sharing, though. For some reason, it's not sharing. Hold on. Stay with me. It's supposed to share it, but for some reason, you know how technologies, we are a slave to technology. So bear with us here a little bit here. And hopefully this time when I do it, it'll come up.
There we go.
Okay, great.
Okay, and you can see that the Dow has been pretty flat, but that doesn't account for all of the volatility that's happened. It's been up and down and up and down, but it ends the week pretty much flat. And right now we're on pace for the best week in the market since early January. So that's a good thing. The NASDAQ is where you see the big change. The NASDAQ is up about 3.3% for the week. And when you look down through the stocks, you can see why it's doing really well. It's up 24 points or 9.5% for the week. And that's a result of all the hoopla that their artificial intelligence is getting. And I don't know if you've looked into that, but it's pretty amazing. I don't profess to know but a little bit about it, but the part I know about it is really intriguing because it can answer things that it's like a high-powered search engine, much more high-powered than we're used to with Google or Bing or whatever. But it's like a advanced level search, and you can get questions answered. I think it's going to change the way everybody thinks and does things because you can get some pretty serious searches and get some pretty serious answers to questions that you could not get before. So, and that's why Microsoft is doing pretty well. But I've always thought Microsoft was a good stock. That's why I own a bunch of it, and I'm very happy that it's up this week. Still not near its high. Its high was in the 330s, I believe, and hopefully it'll get back to that level. Tesla also had a pretty good week. It's up 11 points or 6.4%. Apple did okay too. half, and even Pfizer point, and hopefully we'll start seeing some movement there. Again, that's a stock I have more for a dividend play than expecting great growth because it does pay a healthy dividend, but I'm still expecting to see some growth. So just it's going to continue to be ups and downs. The Fed's meeting next week. The market's going to react to whether or when they increase the rates, whether it'll be a half a point, whether it'll be a quarter of a point, whether they'll talk about how much more it needs to be in the future. That's all going to play on the market. So again, just hold on, be patient, and don't do anything rash.
Yeah, that's very good advice, though, Doug. Because a lot of people, I've been getting a lot of calls lately from a lot of our friends because for 30 years I worked in the regulatory banking industry. That's on the other side of banking. And I first worked for the Federal Savings and Loan Insurance Corporation, which was the agency that actually insured savings and loans. And the FDIC were actually insuring commercial banks. Then Congress, because of the banking crisis of the 80s, they abolished the FISLIC, which was called the Federal Savings Loan Insurance Corporation, to once again instill public confidence in banking. And they created the Resolution Trust Corporation, was supposed to clean up all the banking issues back in the 80s and 90s. Then we rolled into the FDIC. So I saw the 80s banking crisis. I was there. I liquidated banks across the country. I was one of few Black African American males that actually closed the banks. When I would go in, they always thought I was playing for the NBA, and I would tell them no. On behalf of the FDIC, you have been placed into receivership. But this is what people. This is to help people to get understanding about the regulatory business and banking. They not only insure your banks, but obviously they supervise and regulate the banks. But what people don't know, the OCC, the Office of the Control of Currency, they own the majority of banks. I mean, they actually insure. Let me slow down. They actually regulate and supervise the majority of the banks. But FDIC insures the money in all the banks, and that are OCC, and then you got some other regulatory, but the FDIC insures all the banks, and then some they supervise and insure. And the whole key to banking, everybody, one of the major values in the banks is your deposits, the money that you put in there. You know why? Because they take your money and loan it to other people. They're using your money to make money. And so when your money is in there, especially when it's in like a checking account or a savings account, because they know that's going to be pretty steady. Like when you put it in CDs, they know that you might be shopping rates, and as soon as it matures, you're going to look for another rate, and now you can go across states and put money in other states. Thanks to Ronald Reagan with deregulation, where you could then cross state lines and invest money. You used to couldn't do that. You used to couldn't chase a rate in New York, and you lived in Washington, D.C. But thanks to Ronald Reagan, he deregulated, and you could go anywhere in the country. So that made things a little bit more unstable. So what happened with Silicon Valley, everybody? Up to now, they're not sure, but the FBI and the SEC is in there to see if there was any corruption. But right now, there was no identification of corruption. The problem was they put all their eggs in one basket. And isn't that what me and Doug talk about all the time? Diversify your portfolio. In other words, they had a lot of their money invested in venture capitalist firms and small venture capital companies that are start off. They were just loaning them money, out to kazoo. And then they started giving higher interest rates on their savings accounts and CDs. Then so all the people were putting their money in there too because they're chasing the rates. So what happened was they had this exorbitant amount of uninsured deposits, exactly about 175 billion, meaning when the FDIC took them over, if you were over the $250,000 range, which 175 billion was, they were uninsured. So a lot of companies like Roku had their payrolls in there and members is only insured up to $250,000. If you have $1 million, $2,000 that you're paying out on payroll, you're only going to get $250,000. So what happens to save the banking industry, to save the country from panicking? All these people calling me up, Bob, is my money safe? Or what's going on? Is this the end? I mean, dude, I had calls from all kinds of people I haven't heard for years. This is the skinny, you all. If you keep your money under $250,000 per category of accounts, what that means is you can have an individual account of 250,000. You can have a joint account with 250,000. So now you could be insured for 500,000. You can have a business account. That's another 250,000. So it's 750. And you have 4 kids. You can put in trust in each of your 4 kids, and you'll be the owner. And that's another $1 million. So you can insure up to about $1 million if you do it right. But that's about it. But most of my friends, though, were calling me, had something like, 40,000, 5,000. You don't have to worry. It's insured, backed by the full faith and credit of the United States government. That's what the FDIC is. So rest assured, keep a cool head. Don't start panicking. But like we always say, make sure you keep an eye on your money and you have a balanced portfolio that can withstand these future shocks that happen. That's what we talk about all the time. So, though, I want to get into it. We wanted to pause a minute and just talk a little bit about that, because I know we had a lot of questions about those banks that failed, but most of it was just they were too risky. They got too greedy, because when the market was up, they were killing, but when the market dove, they suffered too, especially the bond market. The bond markets went down considerably, and they were heavily invested in bonds to cover their insured deposit. So let's get back to the market, and let's look at cryptocurrency, because dope, let me tell you, last week cryptocurrency looked a little dubious, but
Shaky last week.
it was shaky. But remember, I told you each week for 4 weeks up to that, it was earning 9% a week. Compared to last week, the total market cap of cryptocurrency was $977 billion last week. It's up to 1.1 trillion. It's up 154 billion, the market cap for all cryptocurrency. That's over 9,000 cryptocurrencies. That's a 16% increase. Look at the Bitcoin, dope. Last week, the Bitcoin was selling at $20,205. It's now at $25,154 for one Bitcoin. That's a $4,949 increase, a 24% increase. So if you had your money in Bitcoins, you would have had a 24% increase on your money. Ethereum, the smart contracts, is up $246. It's up 17%. Even Tether, which they call stable coins, was backed by, dollar for dollar. Cryptocurrency, every cryptocurrency in Tether is backed by $1. And even that's up like 0.01 cent, which is only 1%. Even Dogecoin would drop from 8 cents the week before to 6 cents. It's up a penny. And that's about 16% increase when you look at it. So it's weird how the market the other day, though, was down over 500 and something points. But it came back, and the cryptocurrency was down, taking a hit too. And even that's came back. So this is what we're going to talk a little bit about this today, too, about people who try to time the market. It's just highly impossible to do. And if you do it 9 times out of 10, you're luckier more than being some kind of genius. Because if so, all the big financial advisors will be, rolling too. And they've been struggling because everybody's boat's been down when the market, especially from 2022, where we took the market dropped about maybe anywhere from 30 to 40%. but cryptocurrency dropped last year 70%. But things on the rise. So we always say it's about the long term. But let's talk about how this crazy environment just affects people emotionally and mentally, and people aren't sleeping at night because they're worried about their 401k plan. People worry about their bonds, which used to be safe. Treasury bonds and treasury bills, they were supposed to be the safe, and those were volatile.
Yeah, it's really crazy because most folks they got biases that they really don't know about or they don't understand. And a lot of times that can guide your financial choice, but you just aren't aware of it. And most people are so focused on potential dangers that they sometimes perceive things as riskier than maybe that they really are. I mean, it could be risky, but a lot of times since you think so negatively, you think it's a lot worse than it really is. So understanding how investing can make you feel that way can help you build healthier habits. If you know you are a little more worried about, then maybe even you should be, then you can adjust your market investments based on that. And so when markets are volatile and crazy and are going down, most people get a negative vibe and it's, oh man, I should get out of the market. I should be in something safe. There's always that tendency to feel that way. And most people do, and they go to cash, and like I've talked about before, they end up selling when the market's going down, which is the absolute worst time to sell. And they just see the stock prices going down and they think, I got to get out of this. Not looking ahead, but just reacting to what they see the market is doing. And so, most people are just so focused on avoiding danger. And that's what they think they're doing is that negativity bias, that they're getting away from that. And so you focus on that negative thing. A lot of people, that's in their heads, that's how they think, and that could lead you to some very poor investment decisions.
And it's understandable, though, that many investors feel anxious about these turbulent times and turbulent markets. But for the modern day investor, it makes it even harder to cultivate healthy investing habits. And it's human nature. We're not saying people are not human, that it's not going to affect you or you can just, shrug it off. But especially since most people aren't experts at managing their money, and our decisions around investing may tend to be guided a lot of times by our biases. But when the market is volatile, your innate actions may encourage you to sit on the sidelines or even cash out altogether, causing you potential opportunities that you will miss out on. And it undermines your portfolio strategy of the long-term potential. So tonight we're going to talk about some reasons, or we're going to talk about how you can notice some of your own biases and emotional triggers, helping you to make decisions guided by long-term planning, not short-term anxieties. Because, like I say, everybody's human, but we just need to settle down. And the main thing is you need to be able to identify what's going on before you can do anything about it. So, Don, won't you take the first one?
Okay, the first one, and I'm as guilty of this as anybody, but we dislike losses more than we enjoy gains. And so sit back and think about how happy you are if you would find $10 on the street and get put a good smile on your face. But if you lose $10, it probably makes you feel a whole lot worse and it hurts a whole lot more than finding $10. And don't know what that is. And you think about it, $10 is $10. You would think it would have the same effect, but this thing called loss aversion tends to make you feel worse about losing 10 than you are happy about finding 10. And so
That's crazy.
yeah, it's crazy, but I know it's true. I feel that way. And so when it comes to your investment, to paying any loss that you've had over just the past year with the way the market is going can overshadow the fact that over the past decade, you've gained a whole lot. you've made a great gains over that 10-year period, but your focus is on, man, the market is killing me. I don't need to be in here. This, especially if you're checking every day and seeing, oh, the market's down again, the market's down again, and that tends to be what you focus on, and they call it myopic loss aversion. You know, loss after loss compounds, your negative feelings just grow and takes away from any positive feelings of the gains. And if you sit down and say, go back 10 years, look at where you started with. You started with X, and that X may have even doubled. And so you may have lost 20% of that doubled amount, but your focus is on that 20%, not the fact that you have doubled your earnings over the decade. And so that's the kind of thing that you really got to get your arms around and understand that, yeah, the market's down now. It surely is. And nobody's happy about it, but you're still way better off if you've been invested for the last 10 years, even with this loss that we've had the last year. You're much better off. And so, and there's also another phenomena, and this is from Fidelity, and they call it disposition effect. And that describes a tendency to, when things get bad or things get crazy, you want to sell the stocks that have gone up as opposed to selling those that have gone down. Okay. And you you kind of want to keep that hope that I don't want to take this loss. And sometimes it is good to take a loss. Sometimes if a company has Peloton, for example, that was doing really well, ran into issues, there was a time to get out of Peloton. But a lot of people would hold on because you just don't want to take that loss. You don't want to face up to the fact that that's no longer a good investment. So we aren't saying you buy a stock and you never sell it. If you buy a stock for the right reasons and those reasons go away, then it is time to move on. So you got to get your arms around what you're doing. Look at it logically, take a big picture view, and then you make a decision.
Dope. Kitty, who still works at the FDIC, she said, I dropped $10 over a day while in the Safeway. It probably helped someone else, which my 401k had only went down $10 last month. I feel you, Kitty. I feel you. That's just the nature of the beast, isn't it? But dope. Let's just admit. Let's just admit.
To look at her balance 5 years ago.
Yeah, I know. And look, I know she did well, Kitty. I ain't gonna try and put your business out there, girl. But yeah, I bet you look back. Shoot, Kitty, you just look back 3 years ago. I bet you know that you how good you are. And like you said, at least you did help somebody else. But do me a favor. Which store did you drop it at? No, I'm just kidding. So now let's just face it. Uncertainty is just uncomfortable, right? So say you were offered a choice between opening an envelope that you know contains $50 or choosing between two sealed envelopes, right? One that offered $100 and the other one contained nothing. Now, in theory, though, the probability of coming away with $50 with each of these options is equal. Yet experiments, what they did like this, people tend to opt for the sure thing because our natural tendency is to avoid ambiguity and for, not knowing. Risks that feel more certain or known feel better to us than risks that is unknown. That's just the fact. We understand that. But most investors know that it's important to take some level of risk in order to potentially enhance your long-term returns. I mean, that's the whole key about compound interest. It's all about time. The more time you have, the more it gets to compound. But when markets are volatile, our tendency is to back away from uncertainty situations, and they can often prevail. But right now, the market feels extra uncertain to some people. So cash might feel like the right thing to do, the way more assuring option that you feel comfortable with. But some people may feel more comfortable choosing the option when they know what they're getting, even if the long-term gains will likely be smaller.
Hey, Bobby, this is another good one. Now, this one doesn't affect me, but I think it does a lot of people. People tend to value dollars today more than they value future dollars. In a study, they asked people, would you rather have $700 today or $1,000 a year from now? And surprisingly, most people took the immediate payout, even if they were giving up a 30% return on their money. And you make that choice. That's known as present bias. And it's kind of easy to understand how you kind of think in your head, a bird in the hand is what you push. And I'd rather have it today than worry about not having it the next day. But most people put more importance on the current state compared to the future state. But if we've always preached to you about compound interest, returns, and how value can be much higher if you continue to have those money invested. And so that present bias tends to create a situation where we live for today instead of being disciplined, sticking to the disciplined route that helps us in the future. Okay. So, for example, if you're choosing between a brownie and an apple, most people are going to choose the brownie because it tastes good, make that happy day, versus that apple, which should make yourself happy or should make yourself healthy in the future. It's just human nature, and most people do that. But you've got to catch yourself and really think about how much better you're going to be in the future, and that's really hard to do, especially for people who didn't have a lot of money to start with. And so they couldn't see the future being that beneficial. So the only thought was to live for the day. And so you have to force yourself to not spend today, stick to your plan, stick to your discipline, and invest and knowing the future is going to be better. And I know that's easier said than done, but the successful investors, the guys who build wealth, do that, build money for the long term, and are better off for it in the future.
There's a saying that one of the things that, could be worse than being blind is in having eyes and not having no vision. A lot of times and I suffer from it sometimes too, that present bias, because we live for today so much. And a lot of people say, hey, tomorrow don't never come. It's all about today. I'm going to live for today. But, tomorrow does seem to come sometimes, and need to plan a little bit ahead. And we all are victims of that present bias, trying to look at things long term. But you also need to recognize your emotions and decision biases. That decision biases is so prevalent. Now, it can be hard, but it's not impossible to regulate your feelings around investing. The first step is what I said earlier, is recognizing how your investing decisions are informed by your biases. If you can't identify them, how can you correct them, right? So once you're more self-aware, consider one of these tips. Now, this is by person, but look less frequently. Now, me and Dope, we are ones that like to look because we can take it and we like to know, and then with all this fraud that's going on, it's very important that you keep an eye on your money. But some people, they just look so every day, and they say research has found that investors who check their portfolios frequently are less willing to accept the risk. And over the long run, it may reduce their returns because they're looking every day, seeing it go down and down, and it panics, and then they have these biases in their decision because they sort of created it themselves. But this is so individual, this particular one. But be aware of your biases.
And the other one is make sure you do have some sources of safety. Okay. And that can help you rest a little easier, knowing that when you set your portfolio up based on your risk level, you did have some percentage of your funds in an investment that's not very volatile. You had something in cash, or you had something in a dependable bond. You have an emergency fund that may 3, 6 months of money in case you lose your job or in case something bad happens. And you also have things like life insurance or disability insurance in case those catastrophes happen, to let you know that things will still be okay if those things do happen. So that should help you rest a little easier.
Kitty, you're on a roll tonight. Kitty said, I'll take the apple first, then eat the brownie. I ain't mad at you. Oh man. So the next thing is don't go it alone. Automatic investing, such as with the 401k or 403b or 529 plan, can help you keep investing on a regular basis, no matter what is happening in the market. You can also consider professional managed accounts. They got what they call passive management accounts, and they got aggressive managed accounts. And this can help you stick to a disciplined process of investing and help you maintain a diversified portfolio of investments if you engage in the professional managed accounts.
Yeah, and just a note, I do look every day, and I look during the day, but again, it's with no intention to make any fundamental changes. It's just to know. So I do look a lot, but it's not to change. It's just to see what's going on. But one thing you have to remember, downturns are normal. They have happened throughout history. Over the past 150 years, there's been bear markets about every 6 years, and the median loss has been about 33%. But through all those downturns, history showed stocks have always recovered and have always delivered long-term gains. Take a look at this graph, and it talks about some of the big drops in the market when the collapse of the USSR and the Berlin Wall. You can see, if you look really closely, there's a little dip there, but the market moved on afterwards. When you had the dot-com bubble, 11, you can see drops. You had the Iraq War, you can see the drop. But again, right after, the market moved on. The global financial crisis, you can see that dip. But afterwards, the market continued to move. You had Brexit, you got the pandemic. Look how bad it got after the pandemic, but then look how the market has recovered. So right now we're in another bear market, and this too shall pass. So you just have to realize that this isn't abnormal. And I think when you look at it as being abnormal is when you make those rash decisions that are not very good decisions. So just realize this is part of the process. The market is going to have a downturn, and eventually it should recover.
Next, get a plan you can live with through the market's ups and downs. Okay? Now, your mix of stocks and bonds and short term investments will determine your potential returns, but also the likely swings in your portfolio. Now, pick an investment mix that aligns you with your goals, time frame, financial situation, risk tolerance, and you can stick with it despite a volatile, turbulent market. So in this particular graph that we're showing you, it has four different strategies: conservative, balanced growth, and aggressive growth. Obviously, conservative, which is the green, and if it's for people who may be colorblind, the green is bonds. So conservative people would be a little bit more invested in lower risk, not saying no risk, lower risk securities, such as in this thing is suggesting bonds. And the next highest is short-term investments because it's conservative. And on this chart, short-term investments means like money markets and government securities and things like that. Then if you go to a balanced portfolio, it's saying, okay, you're going to be a little bit more mixed with U.S. stocks. That's the 35% in the darker blue. And then, lesser in the bonds and lesser in the short term. Then you go to the growth. And this is where, I sort of find myself. But actually, as I retired, I tried to be less aggressive, but still left some in the growth fund. Now, this saying on the growth, if you taking the growth, which is more riskier, they say put more money, 49% in stocks. And notice they lowering the amount in bonds, which is less riskier. And then they put more in foreign stocks, 21%, and 5% way less in short term. And then if you look at aggressive growth, they're going 60% stocks and 25% foreign stocks. So that's 85%. So let's just right quick, I'm just going to go down to the lines that say the annual return and just show you the difference in the portfolio mix, how they do annually with the particular portfolio mixes that you see here. The conservative, the average annual return was 5.3%. That's the average annual return, yearly return. The balanced approach, which was taking a little bit more risk, 7.99%. Now look at the growth. Took more risk and it was 9%. And aggressive was 9.77. So if you look at the difference between being conservative, being low at 5.93, and you look at the growth 9.5, you make the decision. Is it worth taking that much more risk for a 4% more return, or should I be happy with a 5-6% return? Now look at the worst 12-month return for conservative, because it's conservative, not getting the growth. They lost 17%. The balance 40%. And look at the growth though, 52%. And aggressive 60%. And then the best 12-month return in a year, the conservative actually made not bad, 31%. But look at the balance, 76, almost 77%. And the growth, by taking more risk, 109%. And aggressive, 136%. So this just gives you a little idea of portfolio mix. There's no right formula here. It which bets fits you. Like I said, looking at your time frame, your horizon, your goals, and your risk tolerance. But this gives you an idea of, numbers, actual numbers that actually happen.
And this is one we beat to you before, is focus on time in the market. Don't try to time the market. Nobody's really good at that. If you think about the chart we showed that showed all the big dips in the market and showed the recovery times, nobody can pick, when the pandemic's going to hit or when the market's going to recover from it. And so it can be tempting to think about trying to sell a stock before things go bad because you have a feeling or you have a hunch. But it's hard to pick the right time. If you sell and then the market recovers, you may only miss a few days, but it can have a significant impact on your total performance. So if you look at the chart we got in front of you now, the first one is saying if you had $10,000 invested between January 1st, 1980 and June 30th, 2022, and if you missed the top 10 days, I think the first one is 10 days, right, Bob?
No, the first column left is no. If you stay in and
that's 5. How many days is that?
All days. That's from 1980 to June 2022.
Okay. Yeah, if you missed the highest, and what number of days? I can't see the number of days.
Okay, no. If we're starting from the left, going to the right, it's like you didn't miss any of the days. You stayed invested.
Oh, obviously. Okay, you stayed in the market. That's how much money you would have made on that 10,000. If you stayed in the market that whole time, you didn't go in and go out, and you didn't worry about, oh, I'm going to figure out when I should get out. And the next chart shows you missed the top on what
5
number?
days.
Top 5 days.
No, I'm sorry. No, yeah, you missed the top 5 days. Yeah.
The top 5. And it would only have grown to 695 just by missing those 5 days. And it goes on to tell you how many days it's the more days you miss, the more money you lose. And nobody knows when to get in and get out. So the key thing is everybody would want to be in that first bar on the left and have the 1.06 million because you were totally invested. You didn't worry about the downturns. You didn't worry about the drops. You stayed consistently invested. you know bad things are going to happen, but everything's going to recover from those bad things. And so you move forward.
Hey, Dope, how many people you think did that? Just stayed in?
Oh, I definitely did.
I did too.
No question.
I
No
did
question.
too. But it's so interesting. The far left, the 1.06 million, and the far right, where if you missed the 50 best days from 1980 to 2022, 93% you'd have missed out on. 93%, though.
Which is,
Your money would have just grew $75,000 as opposed to $1 million.
and it,
I
yeah,
just think that is such a telltale sign,
yeah,
of trying to time the market, which people try to do.
yeah, and you just take the stance that's what I did. I pretty much said, I'm going to be invested. And I was fortunate enough that I didn't have to take money out for anything. So even when my kids went to college, I was paying their college out of salary and bonuses and stocks and stuff like that. So I never really had to tap into my investment. So it just grew the whole time I worked for PPG. And that's why I'm in pretty good shape today.
So this is a good question. Kitty says, so you recommend a financial advisor to assist with the thrift savings plan and a 401k plan changes and allocations?
And we're going to have a show on that where we get into specifics. But if that's a tough question to answer in a few words, because you have to focus on how much you know and what you want to invest in. Because if you just say, okay, I'm going to invest into an S&P index fund, and it's been proven that most financial advisors do not beat the S&P index fund, which is just, that's called the total market. That's the S&P 500, the top 500 stocks. Most financial advisors do not beat the S&P index fund. So if you do choose an advisor, and you will review his performance quarterly, semi-annually, or annually, you want to look at how he does in comparison to the S&P index. Because if he's not beating the S&P index, you may as well invest in the S&P index and go from there. You really don't need a financial advisor. So it's tough to say you get one because they all aren't good. Okay, there are some very, very poor financial advisors. So it's not good to get a bad one, and it's tough to get a good one because they're busy with wealthier clients. And then we got to get into, how do you pay? Some people charge based on a percentage of your asset value. Some people charge on transactions. And when there's transactions, there tends to be what's called churning, where they process transactions so they can get paid, not necessarily for you to build wealth. So we're going to do a show particularly on picking a financial advisor. And we're also going to have, as one of our guests, a financial advisor to give his thoughts on the same subject. So
Or
hold,
her.
huh?
You said his or her. It might be a
Well,
female too.
no, it's a he. The guy I'm talking about is a he.
Oh, the
Unless
girl I'm talking about is a female. So
yours is her, mine is a he. But
she, he, her.
yeah, so we're going to hold that question, Kitty.
Yeah, I mean, because like I said, that's a loaded question. But if I was to go and answer it, I would say yes. But then it's financial advisors very rarely do it for free, because if you're going to have somebody to advise you in your thrift savings plan, they're not going to make no money off of it because they're not in the thrift savings plan. But they might charge a fee just to do that. But this is the deal. We're going to talk about it more because we're going to have a show just on that, you all. Probably the next show. It's like, if you don't know, then get some help. We talk about that all the time, you know.
Right.
But
And
you
by
go ahead.
another big push financial advisors will make is to have you transfer that money out of your thrift savings plan
Right.
into an IRA account where they can then manage it and get paid. But if you have suitable choices, suitable investment choices in your savings plan at work, there's really no need to go outside of there. And most of them have, they have things like the S&P index fund and a bond fund and a
or
balance.
ETFs, exchange
Yeah.
traded.
And so what you do is you pick the appropriate percentages of each that you're comfortable with, and that's should be the same thing that an advisor would do. Now, where they may help you is it may be nice to talk to someone about your risk tolerance, and that could be anybody, just so you can truly understand what you're comfortable with and what your needs may be. And it's just a large ball of wax that's really, really, really complicated, but
Yeah.
not that
But
complicated.
you need to look into it for a quick minute though. When you start talking about risk, it's a basic scale, 1 to 5. There's different scales you can use, but the ones I've always used when I was a broker was 1 to 5. 1 being very low, 2 being low, 3 being medium, 4 being high, and 5 being very high. Now I usually ask most people where they think they are. Most people I know said they were 2, right, low. But if you had a home, that automatically puts you in the moderate level of taking risks. A lot of people don't even realize the risk tolerance that they have, though. So it's a good exercise to go through to identify what is your truly risk tolerance, because that really determines, not an advisor, your risk tolerance, your goals, and your time horizon is what dictates what you should be in, and that's so personal. So we're going to talk more about that. We're going to have a show on that because this has come up more than once. But that's a great question, Kitty. Thank you very much for that. Hey, Doug, I just want to talk about one of the. This is one of the concepts we always have talked about between me and you, and that's invest consistently, even in bad times. Now we know that's very tough because we talked about the loss aversion, talked about present bias. A lot of people, when times are hard, it's hard to keep, investing. But some of the best times to buy stocks is when they've been um, at their worst. Consistent investing gets you the discipline to buy stocks when they are at their cheapest. And one way you can do that, just to stay on course, if you're just not disciplined enough to do it, is consider a plan, setting up a plan for automatic investments, and that'll invest every month, at a certain amount. You can do that, but the key is to consistently be in the market, because as you saw that graph that we showed you, the market has, returned. It says over behind all recessions, it's like 13 to 18 months. I don't know. This one may take 2 years, but they always come back. And this is the key with the whole thing that we're talking about tonight, is really being able to understand your investment bias and understand your emotional triggers. That is so important because it is so easy with these turbulent times, and there's so much information now with the internet and social media. And you just flooded with so much information. Sometimes you don't understand, the top from the bottom. So, with that, as we always do, we know we gave you 20 pounds of information in a 10-pound bag. So we're going to go to the summary and takeaways of what we talked about tonight, and hope that we can recap it and really bring it home, and so people can understand it. So, Dope, you take it away.
Okay. And the first one is, don't let your losses get you down. That these are normal downturns in the market. No need to panic. Try to keep a long-term focus. It should go up.
Understand how your feelings affect your decisions. Uh, we all got feelings, and we all got triggers, but the main thing is nobody's no worse, no better off, more controlled than anybody else. We all have our triggers. The key is just try to understand them so you can deal with them, so that you don't get caught up in just making knee-jerk decisions.
Look at today, but focus on tomorrow. There's nothing wrong with taking a peek and see how your money's doing. But again, think long term. Don't react to today. Your focus in the future and on building wealth.
And the last one is invest consistently, even in bad times, because that's the best time to get the cheapest price. It's interesting that when things go low, we tend to want to sell, and then when things go high, we want to buy. That's the opposite philosophy. We should be getting in low and selling high. If you're going to sell.
Yep.
But,
And consistently. So when the price is high, you're buying less shares. When the price is low, you're buying more shares.
and we've talked about that before. And one of the things that help you is the automatic investment plan. And that's what dollar cost investing is about. We talked about that before. If you just consistently, the stocks go up and go down, you're getting them maybe higher, then another time you're getting them lower. But across, when you average them out, you will always make out a lot better than waiting and trying to time the market, which I don't know too many people that can really do that. And, so with that, we hope this was some good information again for you to use. Garnett says she's looking forward to that show where we talked about financial advisors, how to look for financial advisors and what are how do we use them, and why do we use them, and when do we use them. So with that, I just want to say we always give a shout out to all our folks who out there, and our regulars, and Rodney Madison Sr., welcome back from Vegas, Rodney. Glad you're with us. My little brother Carl Chapman. What's up, Chapman? What's up now? I know where you are. Glad you're with us. And then my sisters, Linda and Nolia, are on today. They always there. Man, ain't nothing like family. Just remember, though, blood make you relatives, but love make you families. Hello. Say hello out there to Kitty. And thanks for tuning in. Garnett, always good seeing you, girl. And thank you all for tuning in. And we'll be here next week for our 93rd show, Dope. We're on our way to 100, man. Are we going to do something special, Dope? Like, have a free. Matter of fact, you know what? I'm making this statement right now, Dope. On our 100th show, we're going to give away a free trip to Aruba.
Okay.
You don't seem too excited about that, though. Don't like, boy, what you put on? No. This is a catch, though. The catch is you're free to go to Aruba anytime you want. No, but look, y'all, we're on our way. Thank you for tuning in, you all, and share this information. Get out there and share this information with your family and friends. All right, Dope, you take it easy. And Dope, when's your mother's birthday?
Next Wednesday.
How old is she going to be?
103.
Good gracious, that's a good sign for you, Dope.
Hope so.
Man, Mama Dope. And look, y'all, she's so spry and cognizant, man. At 103, I just hope I'm like that at 73. So anyway, y'all take it easy. Stay tuned and tell your friends, share this information. We love y'all. Thank you very much. Have a great rest of the week.